Silver is at $70 size. And right now, most retail investors are doing one of two things: watching the screen and feeling fear, or not watching at all and hoping. Neither of those is a strategy. What you need right now is a map. Every significant support level between here and the structural floor. What happens at each one, what it means if it holds, what it means if it breaks, and exactly where your decision points are before the price reaches them. Because decisions made in advance of the level are rational. Decisions made when the level is breaking are emotional, and emotional decisions in a liquidation cascade cost more than the drawdown itself. Curious. Here is the complete level map. Level 1, $71.80 to $72.30. The institutional demand zone. Already gone. This was the range where the commitment of traders' data showed commercial long positions clustered, where the volume profile indicated significant buying interest accumulated over months of price action, where institutional buyers were technically positioned to defend. It is gone. Price sliced through $71.80 and $72.30 without a meaningful bounce. When an institutional demand zone fails without a bounce, it tells you one specific thing: the selling pressure is currently stronger than the fundamental buyers. This is a forced selling environment. Technical levels that would hold under normal conditions are getting destroyed because the sellers are not making decisions. They are responding to margin calls. That context matters for every level below. Level 2, $71. The cup and handle invalidation. Already gone. For several weeks, technical analysts were tracking a cup and handle formation on the daily and weekly silver chart. The cup, a rounded bottom where selling gradually exhausts and buyers slowly take over. The handle, brief consolidation before the breakout to new highs. The measured move target from that pattern was pointing significantly higher. The invalidation level was $71. Below $71, the pattern is canceled. The bullish technical structure that justified the trade no longer exists. We broke $71 today. This matters not because of the pattern itself. It matters because of what it means for anyone still holding positions without stops. If the technical structure that justified your entry no longer exists, you are no longer operating a trade. You are holding a position with no defined exit and no defined risk. That is not trading. That is hoping. Hoping is not a strategy at any price level. Level 3, $70. The psychological line. Being tested right now. Every trader on the planet is watching $70. Not because of a specific technical calculation, because human beings think in round numbers. Retail buy orders cluster at $70. Option strikes concentrate at $70. Algorithmic systems reference $70. Financial media writes headlines when $70 breaks. This is the level where the battle between paper sellers and physical buyers is happening in real time. One specific warning about stop placement here. If your stop is sitting at exactly $70, it will be triggered by normal market noise before any meaningful test of the level occurs. The algorithms know where those stops are sitting. They will be found. Place stops at 70-50 for moderate risk tolerance, enough cushion to avoid the noise while limiting downside if the level breaks with conviction. A close below $70, not a touch, a sustained close, is the signal that the next level becomes the target. Level 4, $69, the waterfall entry point. If $70 breaks with a decisive close, $69 is the next reference. But here is what matters most about this specific level. There is nothing between $70 and $69. No historical support clusters, no volume profile nodes, no moving averages of any significance, pure air. When price falls through air in a liquidation environment, it falls fast. Algorithms see no reason to bid into nothing. Sellers keep selling. Price drops through empty space until it finds the next defined floor. Below $69, the next defined floor is $5 lower. That is the waterfall structure. One level breaks and the next test is not 0.50 away, it is $5 away. Understand that dynamic before $70 breaks, not after. Level 5, $64.79. The primary target zone. This is the 50% Fibonacci retracement of the entire silver rally. Full rally from $45.53 to $84.03. The 50% retracement of that range lands at $64.79. The 50% level carries specific significance. It represents the mathematical halfway point of the entire move. Institutional traders pay attention to it because enough other institutional traders are also watching it. That collective attention creates self-fulfilling buying interest at the level. This is where the risk-reward for new entries becomes most analytically attractive. For anyone planning to add to a physical position on this correction, $64.79 is the zone to have cash ready for. Not $70, not 68 A's. $64.79 is where the mathematical support structure is strongest. The path from $70 to $64.79 will produce temporary bounces at $69, $68, $67, $66, $65. Each intermediate level may produce a brief pause, but if $70 breaks decisively, those intermediate levels are unlikely to hold long enough to matter for positioning decisions. The target is $64.79. The path there is $5 of air with speed bumps. Level 6, $60.25. The last structural line. This is the 61.8% Fibonacci retracement of the same rally, the golden ratio level. Below 60.25, most technical frameworks would classify the bull market structure as broken. This is not the base case, with COMEX registered at 78.9 million ounces draining at 2.6 million per active session, with oil at $111 while the 63-year correlation places silver at $95 to $100, with the cumulative structural deficit at 820 million ounces. The structural fundamentals do not support $60, but markets can disconnect from fundamentals for longer than most analysis suggests they should. Know the level exists, have a plan for it, do not be surprised by it. The scenarios that produce $60, a COMEX delivery default, an emergency exchange intervention, a coordinated institutional cash settlement of physical delivery obligations, are tail risks. Low probability, not zero probability. Prepared investors are not surprised by tail risks. They have already decided what they will do before they arrive. Where to place your stops. 3 profiles. Short-term trader using leverage. Conservative, stopped out at $71.50. That level is already gone. If this is your profile and you followed the framework, you are flat and watching for re-entry. Moderate, stop at $70.50. Cushion above the $70 noise zone. Limits downside if $70 breaks with conviction. Aggressive, stop at $69.50. Just above the waterfall entry at $69. Gives room for $70 to be tested and hold without being stopped out. But acknowledge the slippage reality. If $69.50 triggers overnight, your actual fill may be $69.25 or lower. Build that into the calculation. Long-term physical stacker. Stop losses do not apply to physical metal owned outright with no leverage. If you hold silver in physical form, the price on your screen does not change your ounces. You hold the same amount regardless of whether the paper price is $70 or $64 or $50. The paper price determines when you buy more. It does not determine whether the metal you already hold has changed in structural value. Physical stackers do not need stop losses. They need conviction in the thesis and cash available at the levels that represent the strongest entry points. The thesis has not changed. COMEX registered inventory at 78.9 million ounces still draining. Cumulative structural deficit at 820 million ounces and growing. China controlling 60% to 70% of global refined silver supply with export restrictions in place. Oil at $111 against a 63-year correlation that places silver at $95 to $100. None of those structural realities have changed because the paper price is at $70. The paper price is temporary. The physical fundamentals are permanent. The bear case deserves direct acknowledgement. 3 technical frameworks, 4-hour liquidation structure, Fibonacci retracement mathematics, and the sequential support breakdown are all pointing at $64 to $66 as the next defined support zone. The institutional demand zone at $71.80 to $72.30 failed without a bounce. The cup and handle technical structure is invalidated. $70 is being tested in a forced selling environment. In this specific type of environment, defined support levels that would normally hold get violated because sellers are responding to margin calls, not making analytical decisions. The dollar above 100 on the DXY adds mechanical downward pressure on paper silver independent of any physical market dynamic. If Chinese physical buyers step back from the current $5 to $8 arbitrage spread, the paper market loses the Eastern physical floor and the move towards $64 accelerates. The structural case being intact does not protect a leveraged paper position from a liquidation cascade. Understand the difference between the two. 6 levels: 72.30, 71, 70, 69, 64, 79, 60, 25s. 3 of them already violated, 3 of them still ahead. Know exactly what you do at each one before the price arrives there. Check your margin right now. If silver at 65 triggers a forced liquidation, reduce position size before the market does it for you at the worst price. Review your stop placement against the 3-profile framework. Have cash available for $64.79. Watch the $70 close tonight. A sustained close below $70 means $64 is the next defined target and it can arrive fast. A hold and bounce means the immediate technical pressure eases and the structural thesis reasserts. The fundamentals have not changed. COMEX registered inventory still draining. 820 million ounce cumulative deficit still building. Oil at $111 still diverging 25% to 30% from the 63-year silver correlation. China export restrictions still in place. Only the paper price has changed. Paper prices are temporary, physical fundamentals are permanent. Watch the levels. Follow the plan. Let the data determine your decisions, not the price action on your screen at 2 a.m. Invest with logic, not hype. Market Crux. Signing off. Market Crux. All data independently verifiable, not financial advice.